Hello friends, today we are here to revise FR Ind AS 16, CA final FR Ind AS 16 which deals with property, plant and equipment. Friends, you can see a class notes, board notes, handwritten notes, whatever you call it in front of you. You can definitely take a printout of that and sit in front over here. It would be really very helpful. It covers all aspects of practical and theory part of this chapter. But yes, make sure that you sit with pen or pencil because there are a lot of short forms used here and there which would help you later on when you are revising. So without any much ado, let's start with Ind AS 16. Now charted Ind AS 16, you all have studied in intermediate also by the name of Ind AS 10, property, plant and equipment. So basically this standard deals with tangible fixed assets, correct? Now this standard ka overview, this standard overall divided into so many things. First is introduction, which would deal with definition of PPE and what is not included in the PPE. Initial recognition, that means first time when the asset is recorded, what should be the journal entry and at what amount it would be recorded. We would deal that is purchase, construction, deferred credit and exchange. If the asset is acquired by cash, by deferred credit, by exchange, or we have constructed the asset, in that case that is known as initial recognition, correct? So initial recognition and measurement means when we acquired the asset for the first time, what is the journal entries to be passed and at what amount it should be recorded. There are four situations. First, if we have purchased the asset for cash. Second, if we have constructed the asset. Third, we have exchanged the asset. And fourth charted, we have purchased the asset on deferred credit. Subsequent recognition, that means later on, after the acquisition has been done, with certain span of time being passed, whatever expenditure we are incurring, whatever expenses we are incurring, whatever depreciation we are charging, any parts being replaced, how to do accounting for that. And in the end, there are two special situations, that is change in estimate of DSR and first time adoption of the standard. Additional expense, depreciation, component accounting and revaluation. So this standard chartered has been divided into four parts. One is introduction, which gives us the definition of PP and what is not included in this standard. Then initial recognition, we have got four things: purchase, constructed, deferred credit, that means we are making the payment later, and the exchange of asset. Subsequent recognition, that means later on, after acquiring, after certain period of time when we are incurring some expenses, how to treat that. If you are replacing some parts, how to deal with that is component accounting. Then depreciation and revaluation. And last but not the least, there are two special cases. One is DSR and the other is first time adoption. Now charted, meaning of PPE. As you can see, PPE are tangible assets. As soon as I say tangible assets, it implies two things. Two fundamental characteristics of asset is what? Fatafat tell me, what are the two fundamental characteristics? One is control, one is future economic benefit. As soon as I say control has three fundamental things. ये लिखा हुआ नहीं है, it's not written over here, but fundamental has three things. I can use the asset the way I want. I can direct somebody else to use the asset the way I want. And number three is I can stop anybody else from using the asset. If these three rights are there with me, then I can say I have a control over the asset. What are the three rights? I can use the asset the way I want. I can direct anybody else to use the asset the way I want. And third is chartered, I can stop anybody else from using this asset. If these three criteria are fulfilled, I'd say the asset is within my control. Then second comes PPE. Second comes future economic benefit. Future economic benefit means sale, exchange, use or lease. Sale, exchange, use or lease. If I can derive benefit from the asset in either of the four ways, I say the asset has a future economic benefit. Correct? PP ka definition, PP are tangible assets held for use in the production of goods and services. Use in the production of goods and services. That means goods ke liye plant and machinery, services ke liye also. Like I am taking a class, this mic is also a plant and machinery for me because it is helping me to produce service. Second, It is held for used in supply of goods and services. That means those vehicle which help me to supply goods and services. For example, uh, Domino's has those vehicles which helps them supply, deliver pizzas. That is one thing. Services, may suppose I am giving air condition, I am giving furniture on rent, or I am providing decoration material in the marriage or birthday parties. So these are the services I am providing, correct? So for providing services, I have a vehicle which takes the what we say, furniture or bed or decoration material to birthday parties, to marriage ceremonies. So I take it over there. It is used for few hours and again I bring it back. So I'm providing services so that my clients can use this asset. For providing services of this kind, I have a vehicle which takes the assets over there. Clients use it for few days or few hours as the case may be, and then again I bring back the asset. The cost incurred on that vehicle is known as use in supply of goods and services. Rent to others, that means I can let out the property, let out the asset to others and generate rent out of it, like AC on rent. Uh, you must have seen crane, JCB machines on rent on construction. Then you must have seen coolers on rent in marriages. Then you must have seen so many types of machines, cooking vessels, and gas and all that is also given on rent on marriage and birthday parties. But remember, providing land and building on rent is not covered in this standard. That is covered in a separate standard, which is investment property. Am I clear? So PPE are tangible assets which has future economic benefit and we have a control over it. They are held for production of goods and services, supply of goods and services, rental to others, and use in admin purpose. Admin purpose means equipment, furniture. It also includes office decor. Chartered, it also includes office decor, that is painting, safety equipment, that is fire extinguisher, pollution control equipment, standby equipment, that means whenever it is required it is used, that is DG, diesel generator set. Spare parts which are there, spare, maybe have kept parts of some assets or machinery, so when that part gets damaged we replace the part because we have it in a, like you have a printer in the house. For printer you have kept ribbons, correct? So, or you might have a spare keyboards also, you might have a spare mouse also. All these are spare parts. Am I clear? So chartered, and the most important thing, its expected useful life should be for more than 12 months. So if I summarize, PPE is a tangible asset. Asset means future economic benefit and control. It is held for production of goods and services, supply of goods and services, rental to others other than land and building, for use in admin purposes, and it includes office decor, safety equipment and standby equipment. And remember, all these assets ka useful life has to be, expected useful life has to be greater than 12 months. Now chartered, this is a definition of PPE. Apart from this, bearer plant is also PPE. Bearer plant we have discussed at a length in Ind AS 41, that is agriculture. Basically, bearer plants are those plants whose life is more than 12 months and whose fruits can be plucked, harvested and sold. The plant is a bearer plant because it acts like a machine for us, which gives us produce, and the produce we sell, and the life of plant is more than 12 months, like mango tree, apple tree, where we take out the produce and we sell the produce, and the plant or the tree is there with us. Such plant or tree is known as bearer plant. That is also a part of PPE. Now chartered, this standard is not applicable to biological assets, but because for that we have got agriculture Ind AS 41, exploration of site and evaluation. But that means natural resources clear, like oil fields, we do not have this standard exploration. We have got Ind AS 106 for that. But chartered, Ind AS 106 is not in our curriculum. It is not there in our syllabus. So biological assets, exploration and site evaluation of natural resources, non-current asset held for sale. That means we had an asset. Say for example, we had a furniture. We have outlived its useful life, and now we want to sell that asset. So we have classified that asset under a separate Ind AS, that is Ind AS 105, as non-current asset held for sale. It was a non-current asset. It was a PPE earlier. Now we have classified, chartered, now we have classified as held for sale because our intention is to sell under 105. So once it has come out of 16, it is now classified under 105. And standby equipment whose useful life is less than 12 months, land and building for rental, capital appreciation and undetermined use is property, investment property. So these assets are not considered or not covered over here. That is biological assets, exploration, non-current asset, land and building and standby equipment. 5 things which are not counted: biological, natural resources, non-current asset held for sale, land and building for rental, capital appreciation and undetermined use, and standby equipment whose useful life is less than 12 months. Now chartered, this gives us definition of PP. There's a small example: business of giving land and building on rent. That is, business is of giving building on rent, then it's a PP. Business is of furniture and giving building on rent, then it is investment property. My operating in business is only rent, then I will classify building as a PP. But I have got another business, like I'm a teacher, but I have got a property which I have given on rent, then that property I cannot classify as a PP, but it would be classified as investment property. Any asset other than property is given on rent, then it should be treated as PP. Any asset other than land and building which I am giving on rent, my business is of can be anything. For example, I am a teacher, but I have got a JCB machine also which I am giving on rent, then that JCB machine would be treated as my PP, except land and building. If I have got a business of renting out property, then it's a different issue, then I'll classify building as PP. But if I've got a separate business, say of furniture, or I'm a commission agent, or I'm a stockbroker, or I'm a teacher, I'm a manufacturer of bottles, and then I have got building which I've given on rent, then that building would be classified as investment property. That means my business is of renting out, then building is PP. If business is something else, but I'm renting out a property, then that property would be treated as investment property. Very good. Now chartered, any other asset if I am giving on rent, any other asset which I am giving on rent shall be treated as PP. मेरा business कुछ भी हो, I can be a teacher, I can be a manufacturer, I can be an actor, I can be a lawyer, but I am giving JCB on rent, then that JCB shall be treated as my PP. Property on rent to staff, PP. Land and building held for sale in ordinary course of business, then it shall be treated as inventory. क्यों, मेरा काम ही है वही. Land and building held as factory, now held as for sale, then non-current asset held for sale. So land and building on rent, my business is giving on rent, then PP. My business is something else, but I am giving land and building on rent, then it is investment property. Land and building giving on rent to staff, then it is PP. Land and building held for sale in ordinary course of business, that means my business is to sell, that means I am a promoter, then chartered it is inventory. Land and building was PPA, now I have reclassified as held for sale because I want to dispose of that factory, then it is non-current asset held for sale. Any other asset which I am giving on rent, whether I am doing the business of that or not a business of that, irrespective of that, it shall be classified as PP. Correct? Initial recognition. Now chartered, to recognize any item as a PP, there are 2 fundamental conditions. First, its cost can be measured. And secondly, future economic benefit flows to the organization. I can measure the cost and there is a future economic benefit which is flowing to the organization. Then chartered, I can record that asset as a PP. Are you understanding or not? Yes, sir. Now, initial recognition, I had told you there are 4 situations. I can purchase the asset for cash, I have constructed the asset, deferred payment and exchange. Let us consider, see, one by one. Calculation of cost of the asset. Purchase price of PP or material. It is purchased or constructed. Purchase price. If I have purchased, then purchase price of PP. If I am constructing, then purchase price of material. Less trade discount. add non-refundable taxes. Non-refundable taxes. That means those taxes which I have paid, which will not be refunded or adjusted, like GST input tax credit. That GST on which I am not getting an input tax credit should be added over here. Non-refundable taxes, import duty, purchase tax, entry tax, GST whose I am not getting ITC input tax credit नहीं मिल रहा है. Am I clear? Property tax only if it is non-refundable. Any directly attributable cost, any cost, any directly attributable cost for construction of the building, to make the building, to make the property in ready to use condition should be added over here. Any directly attributable cost necessary to bring the PPE in ready to use condition location as intended by the management should be added. Borrowing cost if it is a qualifying asset. And what is qualifying asset? Any assets which normally takes substantial period or more than substantial period to be in ready to use condition. Correct? That we have studied in borrowing cost also charted. Present value of DSR. DSR, this is present value. DSR means decommissioning and site restoration cost. Decommissioning and site restoration. I will come to that. But let us understand what is added or subtracted. Purchase price. From there you subtract trade discount. You get a figure. On that figure we add non-refundable taxes. Correct? Then we add property tax. Then any expenses incurred on the asset to bring the asset to its ready to use condition and its present location as intended by the management. All that expenses should be added. Correct? Borrowing cost if it is a qualifying asset and present value of DSR. So what is added? Non-refundable taxes, property, expenses incurred to make the asset ready to use, borrowing cost and present value of DSR. 5. Non-refundable taxes, property, expenses, borrowing cost and present value of DSR. What is DSR? Suppose chartered I have taken a asset on Lee. I have created a tower on a, say, there was a terrace on which I am a mobile company and Airtel, so my mobile company ka naam is Airtel. On terrace of one, I am raising a that phone ka tower lagta hai, mobile phone ka tower, that I have placed it. So that mobile phone tower is my asset. And there was a condition. So what happened? I made the pillar में एक थोड़ा सा hole बनाया. Then I put the tower and again raised a cement वाला construction किया. Correct. Now chartered after few years when I am supposed to remove the tower, I have to break that construction which I did. And then I have to make sure that the pillar comes back to its original form. So decommissioning and site restoration. So I have to make sure I give back the site in the same form. I give back the site in the same form in which form I had taken the site from the person to whom it belongs to. So any expenditure incurred for decommissioning and site restoration. Site restoration matlab site ko theek kar dena, to bring the site to its original form. Decommissioning means cost of removing the asset. Am I clear? So there are two expenses incurred. Decommissioning means installation ka opposite, you are removing the asset, and site restoration means you will bring back the sites to its original form. Now chartered asset ka life is 10 years. After 10 years I am supposed to remove the asset. After 10 years whatever expenditure I am going to incur for removing the site and for removing the asset and making the site as bringing the site to its original form, whatever expenditure I am incurring chartered, that expenditure I will incur after 10 years. So uska present value you are supposed to bring. Are you understanding? So DSR expenditure, suppose after 10 years I am going to incur 20,000. So 20,000 ka present value I am supposed to incur. Then every year it will unwind. Interest will go up. Are you understanding? So decommissioning means removing asset. Site restoration means bringing the site to its original form. Any expenditure which will be incurred in future for decommissioning and site restoration, its present value should be taken while calculating the cost of the asset. Am I clear? Directly attributable cost does not include. These are the things which it does not include. Rest everything is included. Now, user training cost. It is user training cost. That means the person, suppose I got a new software in the company, it's an intangible asset. So my staff is not trained to use that. The money spent on the staff training so that they can use the software. That expenditure should not be capitalized. Why? Because I do not have any control over staff. After I spend money on training, they can still quit. Correct? Transit insurance. Insurance incurred for bringing the asset from one place to another place. I'm presently located in Bangalore. Correct. Now the asset is in Bombay. I purchased the asset from Bombay. Bombay, the asset is coming to Bangalore. Whatever expenditure is incurred in transit shall not be capitalized for two reasons. Reason number one, that is for road, not for using. Secondly, life of that insurance is definitely less than 1 year, because asset will not take more than 1 year to get transported from one place to another place. So life of that insurance is less than 1 year, so it is not an asset. Secondly, that insurance will benefit only during the transit, not when asset is getting used. Correct. General overhead allocated to the construction. Now, chatted, there's a construction going on, and one of my admin members, to whom I am paying a salary of 10,000 per month. Every day I have told him that to spend 2 hours in the construction site to overlook the affairs of the construction. Correct. I have got an admin staff to whom I am paying 10,000 per month as a salary. I have given him or her the responsibility to overlook the construction 2 hours a day, just to find out that my constructor, the person who is constructing, is not doing any gapla. Correct? No. The construction is going on smoothly. Correct? No. The asset is progressing correctly. Correct? No. They are not sleeping and just smoking away. Correct? No. So all this clearly I have appointed a person. 2 hours every day is looking. Now chartered that person whose salary is how much? 10,000. But every day 2 hours that person is supposed to work 8 hours a day. Out of which 2 hours he is spending on supervising the construction site. On supervising the construction site chartered. So at the end of 1 month, can I say that 2,500, because one-fourth of his time or her time went on supervision. So let me allocate his 2,500 salary to construction cost? No. Suppose for construction, some laborers did not come, sometimes the material have not come, so a lot of phone calls happening. Can I say phone bill ka certain 10% will be allocated to the construction? No. Because of construction, sometimes in the office people were staying late, and we are working for extra 2 hours finalizing in the office. So the plan was finalized. There was discussion. There was discussion on how the asset would be construction. There was discussion with the suppliers, which was taking place generally after the office hours for 2 hours, and it went on for almost 10, 15, 20 days. So can I say 30 hours ka electricity bill should be apportioned to site? No. So general overhead which is incurred in the office, none of that should be apportioned to construction cost. Correct? Yet. Then chartered, after the construction is over, suppose you have constructed a machine or constructed a property, we inaugurate it. And at the time of inauguration, whatever expenses we are incurring for inauguration and party shati, balle shalle, whatever we are doing, uska kharcha, that expenditure shall not be capitalized. Am I clear? Because that expenditure will not give us any benefit in future. Loss incurred because optimum commercial production is not reached, or operating loss. Now I have started a machine which can produce $10,000 in a year, but in the first year itself I am finding that the market has a capacity, or I can sell only $6,000. The machine can produce $10,000. मैं $10,000 $10,000 मैं बना सकता हूँ. I can make it. My machine has a capacity. I have got every penny for it. But market I can sell only 6,000. So I'm producing only 6,000. So $4,000 which I'm not producing, can I say, yo, that is my loss? And that loss, can I say, should be capitalized as the cost of the asset? Nah. Are you understanding? So any loss incurred, if you are producing anything below your normal capacity, that loss chartered shall not be capitalized. Consultancy fees for choosing a PPE. Consultancy fees after the PPE is chosen. When you, brokerage, he helps you choose a plant and machinery, or choose a vehicle, or choose a property, you have kept a consultant. His fee should not be capitalized, because the money which you are paying him, after that you may not buy that asset. Correct? So any expenditure incurred on consultancy fees for acquiring the asset should not be added to the cost of the asset. Cost of soundproofing not required for PPE to run. Now, like this is a studio where I am recording this lecture. It's a soundproof studio. Now, chartered this soundproof studio is mandatory because of recording purpose. So, soundproofing cost should be added to the cost of the studio. Yes, but chartered, this soundproofing will help me or the people sitting outside. Sir, help you. So, working of studio requires soundproofing. Correct. But suppose I have a generator over here. It will make a lot of noise because of which my staff working outside will get disturbed. So platform which I create in which generator is kept, and I make the generator room soundproof. That generator room soundproof will help generator work better or people sitting outside will work better. Sir, people sitting outside, can generator run without soundproof? Yes, sir. So that soundproofing necessary, not necessary? Not necessary, sir. So should be added to the cost, should not be added, should not be added. But in case of studio, soundproofing necessary, not necessary? Necessary. So studio mein soundproofing should be added, should not be added? Sir, should be added. So if any asset where soundproofing is not necessary and you incur soundproofing expenditure, then do not add. You are making it soundproof for outside environment, then it should not be added. Am I clear? Portion of operation cost, same I discussed earlier. This one, general overhead allocated to the construction, portion of operation cost, same thing. Relocation expense of staff. Relocation expense of staff means I have shifted my office and I have to relocate staff also every year. So whatever expenses I am paying to staff to relocate, that should not be added to the cost of the asset. Correct? I started a new office में staff को relocate कर रहा है, तो cost of new office में staff का cost also I capitalize. Allowed, disallowed, baba. Cash discount, that cash discount which I am getting, that I am getting for prompt payment, that I am not getting on the asset. So that discount is also disallowed. So these are most of the examples which are disallowed. Apart from this UNEC, you see any expenditure, it is allowed, it should be added back. Now charted one very important thing. Suppose you are constructing a property. You are constructing a property, you are constructing a theater, cinema theater, or you are constructing a mall, or you are constructing a huge office. You are a big shot man, definitely you can do that. But while the construction might take 3 to 4 years, and that 3 to 4 years ke liye, the construction site par you are giving a space night mein for parking, and you are generating income out of it. That income shall be subtracted from the cost? No, it shall not be subtracted. So income from incidental activities, income from incidental activities done by an entity during construction of PP, such income shall not be reduced from the cost of PP. Such income shall not be reduced from the cost of PP. Example, income from car parking on factory premises during construction. But now chartered, before saying that asset is ready to use, I need to do trial run. Correct? Trial run might produce some goods. So cost of producing that goods in the trial run, the cost of trial run should be added to the cost. Now chartered, trial run might produce some goods. Cost of producing that goods is added to the cost of the asset. Yes. But that goods are sold and generated some revenue. That should be subtracted. Am I clear? So trial run mein whatever goods are produced, then it is sold. Suppose the cost of production of goods is 5 rupees. I sold it for 2 rupees. So net cost is 3 rupees. That 3 rupees should be added to the cost of the asset. Income from goods produced in trial run will be subtracted from the cost of trial run. Net cost of trial run shall be added to the cost of PP. Am I clear? If nothing, QRS means nothing. Question remaining silent. QRS means question remaining silent. Question is silent, they are telling nothing. Otherwise, question will shout and tell refundable tax, non-refundable tax. If nothing is told in the question, then we assume that all taxes are refundable. Am I clear? Now, chartered. Journal entry for such PPEs. PPE account, debit the cost. How to calculate the cost? Purchase price of the material, if you are constructing, or purchase price of PP, as the case may be. From that we subtract trade discount. From that we add expenses, add non-refundable taxes, add expenses incurred to bring the asset into running condition and its present location as intended by the management. इसका एक example लेते हैं. Suppose I purchase an asset which I thought will be used in Chennai का classroom. So asset went to Chennai. So any cost incurred for bringing the asset to Chennai should be added to the cost of the asset. Exactly. But then I decided, nah, the asset should be in Bangalore. So from Chennai again we transported it to Bangalore. That Chennai to Bangalore cost will be added to the asset? No. Intended use of the management as decided at initially. Am I clear? So any expenditure incurred on an asset to bring the asset to running condition and present condition and location as intended by management initially. Initially they thought Chennai. So Chennai ka cost will be added. But then they तुगलक की तरह we have decided, changed our mind. नहीं चेन्नई नहीं, बैंगलोर में asset will be used. तो then we shifted the asset to Bangalore. तो बैंगलोर में शिफ्ट करने का whatever cost is incurred, will that be added? No. Am I clear? So whatever cash, to that we'll add borrowing cost and present value of DSR. DSR we have incurred? No, that's a liability. So chartered bank, whatever we have paid, provision for DSR, that is present value. So chartered asset will come over here, suppose 10 rupees, provision for DSR 2 rupees. This provision will unwind every year. Finance cost to provision. Unwind means compound every year. Correct? Because we have got, suppose we were planning to incur 10 rupees. Its present value is 2 rupees. So every year this will unwind. That we have done it in financial instruments. Every year that will unwind. That interest will be is finance cost, that will be transferred to P&L as finance cost. Am I clear? So provision for DSR will appear in balance sheet liability as non-current liability. Sir, why non-current liability? You are going to incur this cost today or after few years? After few years. So this liability is long-term, short-term, long-term. So where it will appear? Non-current. So non-current liability mein kahan par? Other non-current liabilities or long-term provisions. Long-term provisions. PP acquired on deferred credit. So over here we have studied cash directly at cash and purchased or self-constructed. Second is deferred credit. Deferred credit means we are not paying for PPE today. We'll pay it later. It means payment beyond normal credit term, that is greater than 12 months. Any extra amount paid over normal purchase price, that is cash price, is recognized as an interest. That means chartered, suppose if I purchase the asset on cash, it is 10,000, but if I purchase on EMI, it is 12,000. So 2,000 is interest that should be recognized. Are you understanding? Yes, no, so I'll record. PP 10 to vendor 10. PP 10 to vendor 10. Then interest to vendor 2. Interest to vendor 2. Then vendor to bank. Correct? Yes or no? Yes, sir. So that's what I have done. First cost, cash price, payables to trade payables 10,000. Finance cost to payable, that is interest to vendor, and then payable to bank, whatever money we have paid. So chartered asset, how can we initially acquire the asset? We can initially acquire the asset in 4 ways. Purchase for cash, construction, deferred credit, exchange. Purchase and construction we have dealt. Now deferred credit, that means we are making the payment later on. So due to late payment, obviously the vendor is not my father-in-law. He will definitely charge interest. That interest should be separated. That if I buy today, it is 10. Cash price, if I buy, it is 10. But if I buy in installments, it's costing me 12. So 2,000 is interest. That should not be capitalized, but that should be transferred to P&L. It's an expenditure. Now chartered PP acquired in exchange of other asset. That means exchange of asset. Common sense lagate hain. Chartered this pen. Understand. MRP, listen to this very carefully. MRP of this pen is 12 rupees. How much? MRP of this pen is 12 rupees. But I give shopkeeper 10 rupees cash. What entry you will pass? MRP of pen is 12 rupees, but I give shopkeeper 10. So I'll pass the entry correct. Champion chartered. pen to cash 10 10. Now charted asset acquired. Asset acquired का fair value is how much? So 12. Asset given up. Asset given up is what? Cash. Asset given up ka fair value was what? 10. So asset acquired. This pen ka market price is how much? MRP 12. But how much currency I gave? 10. So cash I gave is 10. So you are recording asset at 12 or 10? 10. This is also exchange only, no? One asset coming, pen, another asset going, cash. So when I am recording pen, I am recording pen at its fair value or the cash which I have given. So the cash which you have given, that means asset acquired pen is recorded at fair value of asset given up. Asset acquired pen is recorded at fair value of asset given up. So chartered pen to asset given up. Suppose chartered asset given up का carrying amount is 10 rupees. But if I sell that asset in the market, I'll get 12 rupees. So fair value of asset given up is how much? 12. So I'll record asset at 12. Correct? No? Common sense karo. I am giving you an asset and against that I am taking pen. So I will assume that pen is worth the fair value of asset which I have given. Correct? No? Are you understanding? Pen is worth the fair value of asset given. Another example. Suppose I was to receive 100 rupees from debtors. I was supposed to receive 100 rupees from debtors. Debtors did not give me 100 rupees. I took pen from them. So my debtors is gone and pen I have received. Debtors was worth how much? 100. So I will consider what is the value of pen for me? 100. Are you understanding? So pen acquired is recorded at fair value of asset given up. Now carrying amount of asset in this case was how much? 10. But if I would have sold that in the market, how much I would have got? 12. So 12 rupees ka asset I am giving and I am taking a pen. So for me, pen is worth how much? 12. So 2 rupees will be recorded in profit. Am I clear? That's what I have recorded over here. Fair pen ka carrying amount 10. Fair value how much? 50. Exchange with wallet. So I am getting wallet, giving pen. So what price shall I record wallet? If I am not giving any cash, then wallet is at 15. Fair value of pen. What I am giving? Pen. What I am getting? Wallet. Pen ka fair value is how much? 15. So what for me wallet is how much? 15. This is fair value of pen. Wallet ka carrying amount, balance sheet mate was appearing at 10. So 10 rupees, 15, 5 rupees PL. Apart, we got a wallet. I got a wallet. I gave pen. For me, pen was worth how much? 15. Plus, I gave 2 rupees cash. Plus, I get 2 rupees cash. So 15 rupees ka pen plus 2 rupees cash. That means wallet ka price is how much? 17. Fair value of pen plus cash paid. But if fair value of wallet was given, then PL is equal to balance. If this was given, then PL will become balancing figure. We received cash. I gave him pen. He gave me wallet and 3 rupees. That means against that pen, he was supposed to pay me how much? What is the fair value of pen? Sir, 50. So he is supposed to give me goods worth rupees 15 only, no? Yes. So he gave me cash 3. The wallet was worth how much? Sir, 12. So fair value of pen minus cash received. Correct. Now charted. So PPE. Cost of PPE acquired. PPE to other assets. I have acquired PPE and I have given off one asset. I have acquired PPE and I have given off one asset. The asset which I have given up will be credited at carrying amount, balance sheet wala value. This should be recorded at which cost? Fair value of asset given. Now chartered, इसमें एक लफड़ा है. इतनी बात समझ में आ गई? Yes. Did you understand this much? Yes. When I am giving one asset and I am taking one asset, we need to check one thing, that does there exist a commercial substance? Sir, what is commercial substance? Relax. When we are doing exchange transaction, what we are supposed to check? Sir, whether there is a commercial substance or not. What is commercial substance? Wait. Let us assume commercial substance is there. Then the fair value of asset acquired is equal to fair value of, sorry, cost of asset acquired is equal to fair value of asset given up. That is first preference. If fair value of asset given up is not there, then the fair value of asset acquired. Correct? First preference. देखो, if exchange transaction has commercial substance, cost of PP acquired, fair value of asset given up. Second preference, fair value of asset acquired. Third preference, carrying amount of asset given up. That means whatever is the value appearing in the books, that is the value of asset which I am getting. Are you understanding? Yes. So first is fair value of asset given up. Second is fair value of asset acquired. Third is carrying amount of asset given. That means the price at which it is appearing in the books, that is only fair value. But if commercial substance does not exist, then you cannot account for profit or loss. Remember this line. If commercial substance does not exist, then you cannot account for profit or loss. So if I am giving you pen, which is in my books 10 rupees, fair value is 15, then I will always say, if there is no commercial substance, whatever asset you are giving me, its cost is 10 only. In my books, pen is how much? 10. Fair value how much? 15. I am giving you pen. You are giving me one asset. That asset ka cost is how much? Commercial substance is not there. 10 or 15. If commercial substance is there, then 15. If commercial substance is not there, then 10. Why? Because you cannot account for profit or loss. यहाँ पे लिखा हुआ है. It's written. Carrying amount of asset given up and do not recognize any gain or loss. सर ये commercial substance क्या होता है? Commercial substance means financial benefit. If the asset which I am giving and the asset which I am getting, there is a financial benefit to both the parties, financial benefit or financial loss to both the parties. Means transaction affects cash flow of the entity. Financial benefit, how we would decide? It impacts the cash flows of the entity. Remember, this is very, very important. How to check whether commercial substance exists or does not exist. Now chartered. Commercial substance exists ka examples. I give you agricultural land. And you gave me 4 flats on rent. Correct, rented flats. So I gave you agricultural land and you gave me a land which is on rent. So we are exchanging land, but one is agricultural, which one is commercial. So can I say, even if the fair values are same, even if both is land, but the fair values will be different. One is agriculture and one is commercial. Yes, that means commercial substance exists. Second, I am giving you land, you are giving me 4 flats. Kya value of 4 flats and value of ready-made flats is same? No. Even if the area is same, their fair value will be different. Land is not generating revenue. 4 flats are ready to generate revenue today only. Correct? So there is a difference in cash flows. Exchange of mobile towers. One mobile tower, another mobile tower. This is Airtel ka mobile tower, this is Jio ka mobile tower. And they have exchanged the mobile tower. Why? Because on the database they have. Am I clear? So mobile towers ka exchange also will lead to difference in cash flow. I have a mobile tower, Jio has a mobile tower in North Bangalore. But Airtel has more customer in North Bangalore. Correct. Airtel has a mobile tower in South Bangalore. But Jio has more customer in South Bangalore. So they exchange the mobile towers. So they don't have to pay each other too much money. Am I clear? So that is again commercial benefit. Now this is amazing example. Ram has an office in north and go down in south. Shyam has office in south and go down in north. Office north, go down south. Office south, go down north. They interchange, go down. Don't you think they are going to save money? Now Ram and Shyam exchange go downs. In all the above examples, we have assumed, these are all examples, then don't you think Ram and Shyam will save money because go down and office are nearby? So it will impact the cash flows of the entity. Yes, that means commercial substance exists. So all these 4 cases mein, beta, commercial substance exists. I give you agricultural land, you give me commercial land. I give you land, you give me flat. we exchange my mobile tower and your mobile tower. We have exchanged. Why? Because of the customer base. Your godown, my godown, we have exchanged. Why? Because we have chosen the godown which is closer to our office. So all this will impact our cash flows. In all the above examples, we have assumed that fair value of both the assets are almost same. But still it will impact go down, same. Mobile tower, same. Land and 4 flats, value same, but who can generate cash flows immediately? Land. Agricultural land, land on rent. Maybe the agricultural land is big, land on rent is small. Both ka fair value same, but cash flows will be different. No, agricultural land will generate less rent, commercial land will generate more rent. Am I clear? So we have assumed that the fair value is same. That means difference in fair value is less than 10%. The difference in their fair value is not substantial. Substantial means more than 10%. Now, chartered, understand this very, very carefully. So, how do we identify that a transaction lacks commercial substance or has commercial substance? If it impacts the cash flows of the entity. Matlab, either the cash flow will increase or cash flow will decrease. Correct? Now, chartered, secondly, fair value should be same. If fair value is different, then the commercial substance by default exists. If fair value is different, that means the fair value of the asset exchange has a difference of more than 10%, then the commercial substance exists. I am giving you 10 rupees ka asset and taking 12 rupees ka asset. So for one it is profit, for other it is loss. That is inevitable. So commercial substance exists if the fair value of the asset is substantially different. But if the fair value asset is not substantially different, that means the fair value of both the asset exchange is less than 10%, impacts cash flow, does not impact cash flow. If fair value is same and it does not impact cash flow, then commercial substance does not exist. If fair value is same and impacts cash flows, then commercial substance exists. Am I clear, chartered? Yes or no? Yes, sir. Now, subsequent measurement. अब ये subsequent measurement क्या होता है? Any expenditure incurred on the asset later on, after few years, additional expenditure. The expenditure which I am incurring on the asset, that expenditure gives us benefit for more than 12 months, then capitalize the cost as a part of old asset or separate asset, as the case may be, if the remaining useful life of the asset is greater than useful life of the additional expense. Separate if the remaining useful life of the old asset is not equal to useful life of additional asset. Now ध्यान से समझते हैं. Now chartered, there's a building. उसमें मैंने पेंटिंग किया. That painting का life is more than 1 year, less than 1 year? Sir, more than 1 year. So additional expenditure, life more than 1 year. It should be capitalized. That is decided. Correct? Yes. Now, painting I did today, it will last for 5 years. Painting I did today on the building, and that painting ka life is 5 years. That painting should be added to the asset. It should be capitalized, that is for sure. But that painting should be added to the cost of the asset or should be sold as a separate asset. Now, remaining life of painting is how much? 5 years. Remaining life of building is how much? Sir, 5 years. Add. Remaining life of building is how much? Sir, 15 years. Remaining life of painting is how much? Sir, 5 years. Show painting as a separate asset. Oh, are you understanding? Yes, sir. Similarly chartered, there is additional expenditure incurred. You have seen airport mein the travel luggage, conveyors belt we call, we pull out the travelers luggage. That conveyor belt has a major overhaul expenditure every 3 years, major inspection cost every 3 years. So that expenditure ka benefit is 1 year or more than 1 year? Sir, more than 1 year. Should be capitalized, should not be capitalized? Sir, should be capitalized. Now conveyor belt ka remaining useful life, sir, 3 years. This expenditure ka useful life 3 years. Match. Capitalize the overall expenditure. Major inspection ka cost should be capitalized. But conveyor belt ka useful life, sir, 8 years. Inspection ka life 3 years. Capitalize as a separate asset. Am I clear? Yes. So you have to, that is a judgment call which you are supposed to take. Am I clear? And always remember that asset should independently bring the benefit. If the expenditure brings the asset back to its original form, generally it should not be capitalized. But I am of the firm belief, because standard over here very clearly state, if that expenditure independently can give you benefit for more than 1 year, yes, capitalize it. So the expenditure which you are incurring, if that expenditure ka benefit is more than 1 year, you should capitalize it. For example, I'll tell you that major inspection cost. Now, chartered suno, when I purchase a new conveyor belt, do I have to do any major inspection? No. So that was done. Ekdam proper, prim and proper condition. Then after 3 years, I have to incur major overhaul and inspection cost. That is recurring after every 3 years. So after 3 years, when I incur that expenditure, will my conveyor belt become better than the original? No. At max, it can come back to its original form. Should I capitalize? I should not capitalize. If I go according to the old theory, that any expenditure incurred on an asset will bring the asset to its original form, should not be capitalized. Enhances the life capacity of the asset, should be capitalized. Over here, it will bring back the asset to its original form only. Will it increase the efficiency? Maybe efficiency again back to normal only. Will it increase the life of the asset? No, it will maintain the life of the asset. But that expenditure ka benefit is 1 year, more than 1 year. Sir, more than 1 year. Should be capitalized, should not be capitalized. Standard says capitalized. But should be added to the asset or should be shown separately? If the life of that expenditure and the remaining life of the asset is same, then add it. Otherwise, show it separately. Component accounting. Am I clear? Yes. Charging depreciation. This too, you have been doing it from 11th standard. You must be champion. This too, you can only help me. Correct. Depreciation. Depreciation means what? Decrease in the value of asset. Correct. Now, depreciation basically means total cost of the asset spread over its useful life. Simplest definition of depreciation is total cost of the asset spread over its useful life. Decrease in the value of asset because of continuous usage, I would call it impairment, not depreciation. That definition is obsolete. Decrease in the value of asset because of continuous usage, wear and tear, obsolescence. Don't you think that is somewhere representing the decrease in the value of asset because of internal damage? So don't you think that should be treated as impairment and not depreciation? So if asset has asset ka cost, we are spreading off over its useful life. That is depreciation. If the value of asset decreases because of wear and tear, efflux of time, all that, wear and tear, obsolescence, then don't you think they are indicators of impairment? So that definition has become obsolete. It is not, that definition is not written in AS also or Ind AS also. So we will stick to a definition of depreciation as depreciation is the cost of the asset which is spread over its useful life. Now chartered depreciation. Now depreciation SLM, straight line method, WDV, reducing balance method, diminishing balance method. Other method means production unit method, machine hour rate method. Any method we can follow. Am I clear? But chartered total depreciation will never change. Total depreciation will never change. For example, cost 100, scrap value 20, life 4 years. That means in 4 years asset will depreciate how much? 80 rupees under any method. 80 rupees asset will depreciate under any method. Either you depreciate 20, 20, 20, assuming benefit derived from the asset is same, or you can depreciate in any other ratio. But the total depreciation over the long period should be same. So if I follow SLM, then 100 rupees ka asset, 20 depreciation, 80 is remaining, 20 depreciation, 60 is remaining. So every year depreciation is 20, 20, 20. But if I do WDV, I have to first find out the rate using this formula, 1 minus scrap value divided by cost to the power 1 by n. So I found out the depreciation rate to be 33 1/3%. So first year ka depreciation 33, value of asset remaining 67. Again 1/3 depreciation 22, value of asset remaining 45. 45 ka 1/3 depreciation 30, 30 ka 1/3 depreciation 20. So first year ka depreciation 33, second year ka depreciation 22, third year ka depreciation 15, fourth year ka depreciation 10. If I add all the depreciation, will come to 80 only. So whether you use SLM or WDV, it should be same. You are supposed to calculate the depreciation rate by using this formula, 1 minus scrap value. This is compound interest का formulas में compound interest का formula है ना, amount is equal to principal 1 plus I to the power n. This is WDV is equal to original cost, or I can say scrap value is equal to cost 1 minus I, because the future value is decreasing, 1 minus I to the power n. If you make I the subject of the formula, then scrap value divided by cost, correct, to the power 1 by n, 1 minus this. So in this formula, if you make I the subject of the formula, you get this. I am sure you are not into derivation of formulas. If you remember the formula, that is more than enough, or a rough idea how it came, correct. So under any method, whatever depreciation and all the circumstances will be 80 over a period of 4 years. Depreciation is charged from the day asset is ready to use or put to use. Ready to use. RTU means ready to use. Depreciation ceases when asset is sold. Tata bye bye. Or you have classified that asset as held for sale. Correct? Choice of depreciation management should be based on consumption pattern and not on revenue pattern. That means you cannot charge depreciation in the ratio of sales. You can charge depreciation in the ratio of hours used, bottles produced. You cannot charge depreciation in the ratio of revenue generated. But it should be on the consumption pattern. Why? Because it is a part of cost. If PPE is consisting of land and building, then land obviously does not depreciate, then building should be charged. Or it's better to show land and building separately in balance sheet. But if you are showing as a combined figure, then only charge depreciation on the building element. If there is a change in depreciation method, useful life or scrap value, that means re-estimation. Then it is known as change in accounting estimate, and you are supposed to do accounting prospectively. Correct? This all you have studied in your inter only, but still, if there is a change in method of depreciation from SLM to WW, WDV to SLM, useful life, you thought 20 years, now 10 years. You thought scrap value 50,000, now 30,000. So because of change of this, you are supposed to change the method in the year of change only. You are not supposed to go past. It's a prospective change. Then it is considered as change in accounting estimate, and hence effect should be given prospectively over remaining useful life on carrying amount of PP as on the date of change. Now chartered, suppose asset is 100 rupees, scrap value 20, depreciation life 10 years. Correct? So depreciation is how much? 8 rupees. 3 years ka depreciation gone. So 8 3 ja 24 is the depreciation. The value of asset remaining is 100 minus 2476. Now we assume that now chartered we assume, or we find out that the scrap value is only 10. Life remaining was logically 7, but we assume 6. We feel no, asset will not run for another 7 years, but it will run for another 6 years only. And after 6 years, will not receive 20, but will receive 10 only. Then chartered will divide it by 6. Then 66 divided by 6. Depreciation from next year, you will start charging 11 rupees. Nothing extra doing. Life is simple. Sir. Yes, sir. Tell once again. 100 rupees cost of the asset. 20 rupees depreciation divided by life, 10 years. Correct? So depreciation is how much? 8 rupees every year. 3 years, 24 rupees asset has depreciation. So 3 years have gone. So remaining useful life is 7 years. Out of 100, 24 it has depreciated. So value of asset remaining 76. Now we are assuming that scrap value is not 20, but it will be 10. Okay. Life remaining is not remaining 7, but 6 only. Then from next year we will start depreciation on 11. Correct? Depreciation ka journal entry, depreciation to PP or accumulated depreciation to accumulated depreciation. I am sure that everybody has studied this journal entry, and I am sure everybody is doing articleship and would have realized that in reality we do this journal entry, depreciation to accumulated depreciation. So question remaining silent, this is the depreciation entry. Why? Because Companies Act follows this. Accounts has told anything. Now chartered component. If component accounting, if any component which has a significant cost should be depreciated over its useful life. That means laptop and RAM should be depreciated separately. You can show together. You can say, so suppose car is total 1 lakh. We can say body 40,000, engine 60,000. Body का life 5 years, engine का life 10 years. Correct? So body का depreciation 8,000, engine का depreciation 6,000. The total depreciation 14,000 you will subtract. So in balance sheet you can show a total consolidated figure of car, but while calculating depreciation it should be calculated separately. Body and engine. Correct. Part of PPE which has a significant cost should be depreciated over its useful life. Its useful life means in the useful life of that part, significant cost. Now chartered. Engine of a car, turbine or aircraft, turbine of a machine, engine of a car or aircraft, which is a substantial cost. Turbine of a machine, interior of a building, roof of a building, major inspection I told you, major overhauling, any expense whose frequency is greater than 12 months. Is useful life of significant, if useful life of significant cost is equal to useful life of PP, then no need to depreciate separately. I told you, if it matches, same expense ala funda. If it matches, then depreciate along with the asset. But if the useful life is different, then show it separately. In balance sheet, you will show it as one consolidated asset. But in schedule, you will show the asset separately, depreciate it separately. Am I clear? If a part having significant cost is replaced, now this is interesting. Now, if the part having significant cost is replaced, that means you are replacing the part. So, old part is going, new part is coming. So, old part ka book value de-recognize, new part ka cost you recognize. Old part ka book value, carrying amount you de-recognize. That means you will pass the entry PL to PPE. Old part de-recognized. New part recognized. So, old part de-recognized ka journal entry PL to PPE. I've removed it. New part ka cost you will recognize PPE to bank. Now chartered, as I told you, there are suppose two parts. Suppose one part is 100, 200, total 300 is the cost of the asset. Iska life 5 years, iska life 10 years. So both are depreciating at 20, 20, 20, 80 and 180. So 40 depreciated, you are left with 260. 20, 20, 60, 160. Again 40 depreciated, you are left with 220. Correct? Again 20, 20 depreciated. So 40, 140. 40 depreciated, we are left with 180. Now this part we are removing. So de-recognize, remove 40. You are left with 140. When we found out, iska new part ka cost is 50. So add back 50. So it will appear as 190. Now this will be 50. 50 ka life is how many years? Say 5 years. Now iska depreciation 10, iska depreciation 20. So next year ka depreciation 30. 160. Are you understanding how I am going? So this asset left is 40, this asset left is 120. Again 10 depreciation, 30, sorry, and 100. So depreciation is how much? 30. It will go on like this. Correct? Now, this is simple. So it will de-recognize the cost and recognize the book value. Now chartered, the problem is, if you do not have the book value of the asset, if the book value of the old part is not given, like 300 ka asset is there. How much ka asset? 300 ka asset is there. And there are two parts. Part 1, part 2, we don't know. Every year we were charging 60 depreciation, 240, 60 depreciation, 180. 2 years have gone. Now this part is replaced after 2 years. Year 0, year 1, year 2. Over year it is replaced. But in this 180, how much is this part? We don't know. Then what we will do? Today that part is available for say 50 rupees. Today that part is available for 50 rupees. Correct? Find out its present value. Discounted. Its present value comes to 40. Life of that part is 5 years. So then 8 rupees depreciation, 8 rupees depreciation. 8, 8, 16 gone, you are left with 24. So you de-recognize 24 and add 50. Oh, so sir, I understood, but you tell, I'll recap. This part 1 ka cost is not available. So year 0, year 1, year 2. Today that part cost 50 rupees. Find out its present value, discounting factor, let's say 10%. So 10% is 0.9091, then 0.8264 से multiply किया. So you got one value. Let's assume 40 for easier calculation. So you found out its cost 2 years ago. Today if the cost is 100 rupees, 2 years ago its cost is 40 rupees. This 40 rupee asset has depreciated over a period of 2 years. Its life was how much? 5 years. So 2 years में how much it depreciated? 8. 40 divided by 5 is 8 rupees depreciation. This asset का life is how many years? 5 years. तो 5 से divide किया, 1 year का depreciation 2, so 16. तो 40 में से 16 depreciated. तो 40 में से 16 depreciated, तो you're left with how much? 24. Correct? So 180 minus 24 plus 50. Is this clear? Yes or no? That's what it is written. So if part having significant cost is replaced, then cost of new part is added to the carrying amount of PPE as on the date of replacement. As on the date of replacement. Written down value of old part is derecognized, subtracted from carrying amount of PPE. What we discussed, it is written over here. Now chartered, when we acquire the initial recognition is done at cost, but subsequent recognition में the entity has two options, cost model or revaluation model. Correct? Now subsequent recognition at balance sheet date. Subsequent recognition at balance sheet date, cost model or revaluation model. Chosen accounting policy, that is either cost model or revaluation model, will apply to the entire class of PPE. Note, class of PPE means group of assets having similar nature and use. Cost model, cost less accumulated depreciation less impairment is equal to carrying amount. Over here, carrying amount will become the fair value of the asset as on the date of revaluation. Depreciation should be calculated on fair value of the asset. Depreciation should be calculated on fair value of the asset, correct? Revalued amount. Now, revaluation entries. Revaluation entries can be done in two ways. If we are maintaining chartered provision for depreciation, or we are not maintaining provision for depreciation. So depreciation is charged directly to PP, that is PP is appearing at WDV. That means depreciation entry we have passed depreciation to PP. That means there is no accumulated depreciation, there is no provision for depreciation. Then how we would do revaluation? Cost of the asset 100, PP has gone to 120. So we transfer 20 rupees to revaluation reserve, that is OCI, non-reclassifiable. Increase we do not transfer to PLY because conservatism principle. Subsequently chartered, if the fair value from 120 has become 130, then additional 10 also will go to revaluation. But if the subsequent from 120 it became 90, so it is decreasing by how much? 30. That 30 would be first be set off with revaluation reserve to the extent of 20, because in revaluation we had 20. So 20 revaluation reserve, extra 10 to P&L, to PPE 30. Correct? Yes, sir. Now chartered. So this is first time upward revaluation, subsequently upward revaluation. Then both will go to revaluation. First time chartered, upward revaluation, second time downward. The second time when you are doing downward subsequently, then first you will set off revaluation reserve. If there is further downward, then you will transfer it to PN. Reverse over here. If first is downward, from 100 it became 90. So 10 rupees will go to PL. Subsequently again decreasing only. Then 5 will go to PL. But from 90 it is becoming 105. So it is gaining 15. It is gaining 15. That 15 will not be transferred entirely to revaluation reserve. First we had transferred 10 to PL, so recover that PL. Whatever loss we had transferred it to PL, first recover that PL. Excess should be transferred to revaluation reserve. Correct? If depreciation is charged to accumulated depreciation, that PP is appearing at cost. In this, there is a trick. Suppose PP 200, accumulated depreciation 40, then carrying amount 160. Fair value is becoming 240. That means logically you see it is increasing by 80 rupees. Correct? In this situation, directly you will not pass this entry. PPE to revaluation reserve 2020. Because if you pass PPE to revaluation reserve 80, then this PPE will increase. We are supposed to increase the carrying amount. So what do we do? First option is eliminate accumulated depreciation. So whatever accumulated depreciation entry you had passed, accumulated depreciation to asset. Sorry, you had passed the entry depreciation to accumulated depreciation. So that accumulated depreciation you remove it. That accumulated depreciation charted you remove it. So accumulated depreciation to asset. So your accumulated depreciation has gone and asset has now become 160. So elimination of accumulated depreciation, then you pass the normal entry. Correct? And subsequently whatever we did here, same thing will follow. But if you don't want to remove accumulated depreciation, then see from 160 it is becoming how much? 240. So asset is increasing by 80. That is 50%. So you increase this asset also by 50%, this accumulated depreciation also by 50%. This asset you increase by 50%, that means it will increase by 100, and accumulated depreciation 50%, 50% of 40 is how much? 20. So this will increase by 100, this will increase by 20. Am I clear? So PP 100 to accumulated depreciation 20 to revaluation reserve 80. Correct? So if there is no revaluation reserve, if there is no accumulated depreciation, you follow this. If there is accumulated depreciation, you follow this. In this, you have got two approaches. One is elimination. You remove accumulated depreciation by debiting accumulated depreciation and crediting PP. That means accumulated depreciation will go and PP will reduce. So PP will come at written down value. Then you can do normal revaluation as you did in the first case. But if you do not want to remove accumulated depreciation, then check by what percentage it is increasing. From 160 to 240, it is increasing by 80. 80 is 50%. So 50% of 200, increase it by 100. 50% of 40, increase it by 20. So PP is increasing by 100, accumulated depreciation by 20, revaluation reserve 80. So it would look like this. Carrying amount 300, accumulated depreciation 60, now 240. Subsequently also follow the same proportionate increase or decrease. Proportionate increase or decrease, and in case of decrease use revaluation first as done in case 1. As done in case 1. Correct? So charted, in case of revaluation there are two methods, without provision and with provision. With provision में two options, elimination of accumulated depreciation or proportionate increase or decrease. Am I clear? If nothing is mentioned, you will follow accumulated depreciation and proportionate. If nothing is mentioned, you will follow accumulated depreciation and proportionate. Revaluation reserve will be when asset is sold. Revaluation reserve is shown in OCI non-reclassifiable. Correct? When asset is sold, you will transfer revaluation reserve to retained earnings. Balance of revaluation reserve is transferred to retained earning when the asset is sold. When to do revaluation? If the asset is volatile, then you should do revaluation annually. If the asset is non-volatile, you should do revaluation annually. If the asset is non-volatile, you should do revaluation 3 to 5 years. Basically, entity should ensure fair value is not significantly different from carrying amount. You should try to maintain that the fair value and the carrying amount is almost the same. Now charted. This is interesting. Suppose the cost of the asset is 100. Depreciation 3 years ka cost of the asset is 100, life is 10 years. So every year ka depreciation 10 rupees. Suppose 3 years tak we went on doing depreciation. So 100 rupees is the cost, 10 years is the life. So depreciation per year is how much? 10 rupees. 3 years ka depreciation 30, asset value became 70. Now the asset is revalued to 105. From 70 it became 105. So there is a revaluation surplus of 35. Revaluation reserve, that is OCI non-reclassified. Now charted depreciation for 4th year. Now this 105, 3 years of asset has depreciated. Now the life of asset remaining is 7 years. So 105 divided by 7, that is 15 rupees. Correct. Now this 15 rupees ka journal entry is depreciation to PPE, PL to depreciation. So earlier how much used to go to PNL? 10 rupees. Now how much will go to PNL? 15. Now some of them argued that if due to revaluation excess depreciation is going to PL, if excess depreciation is going to PL, profit available for distribution of dividend is decreasing. Yes. So Ind AS gives us an alternative that if depreciation is 15, you can transfer 10 rupees old depreciation to PNL, and excess depreciation which you are getting because of revaluation should be reduced from revaluation reserve. Am I clear? So normally we'll pass this entry, but if the company wants, they can transfer old depreciation to PL and excess depreciation caused because of revaluation to revaluation reserve. Am I clear? Ind AS states company may transfer excess depreciation of rupees 5 due to revaluation from OCI to retained earnings in SOCI. So this will reduce 5 rupees, you will remove from OCI and transfer it to retained earnings. Am I clear? Are you an company may transfer excess depreciation rupees 5 due to revaluation from OCI to retained earnings in SOCI. So you are not supposed to pass this journal entry charted. But this revaluation reserve, you are supposed to transfer, this revaluation reserve, you are supposed to transfer, remove from revaluation reserve and transfer it to retained earnings in where? Statement showing changes in equity. So profit available for distribution will remain same. The retained earnings will be same. Am I clear? So we'll pass this entry. Earlier people used to pass this entry, excess depreciation to revaluation reserve, but in days you will not pass this entry. So PNL में 50 का impact दिया, but 5 rupees you transferred from revaluation reserve to retained earnings. So retained earnings में 15 rupees depreciation went, but 5 rupees SOCI से आ गया, sorry, revaluation reserve से आ गया. So it again became same. Sir, can we pass this entry? It is not stated very clearly, but ultimately your PNL may will show impact of 15 rupees. Your profit will dip by 15. So retained earnings dipped by 15. Then you remove 5 rupees from retained earnings, 5 rupees from revaluation reserves and add it to retained earnings. Am I clear? I repeat. You transfer in PNL how much? 15 rupees depreciation. So your profit will dip by 15. Your retained earnings will also dip by 15. Fair enough. Then from revaluation reserve you remove 5 and add it to retained earnings. So retained earnings will increase by 5. So net impact in retained earnings is rupees 10 only. Am I clear? Yes, sir. Journal entry for sale. Carrying amount 50. Revaluation reserve 10. You sold the asset for 65. So profit is how much? 15. Transfer evaluation reserve to retained earnings. Selling price is 60. Profit is 10. Transfer evaluation reserve to retained earnings. Correct? Sold it for 30. So there is a loss of 20. So 30 rupees revaluation reserve 10, you will use it here, excess loss PL. You sold it for 45, so only 5 rupees is lost. That 5 rupees loss you will set it from revaluation reserve. Balance in revaluation reserve 5, that will transfer from revaluation reserve to retained earning. So when asset is sold, revaluation reserve is transferred to retained earnings, because if there is no asset, you don't require revaluation reserve. But if there is a loss while selling the asset, that loss should be first set off against revaluation reserve charted. Am I clear? Yes or no? Yes, sir. Correct. Now, this is one note which will help you in theory questions. Compensation receivable from insurance company due to damage in PPE is accounted separately as other income in SPL. Special issues, change in estimated amount of DSR. That means we had thought that DSR will be 20,000. So we found out the present value. Correct? Now we are saying, no, DSR will be 30,000. Now, in this case chartered, let us understand that suppose life of the asset 0, year 10. Over year we had thought we will spend 10,000, 20,000. So we found out its present value 5,000. Every year it was increasing. Year 1, year 2, year 3, it kept on increasing. And today suppose the balance is 7,000. Now we assume it will be 30. So 30,000 ka present value of past 7 years, only 7 years. Correct? So first estimate the DSR, then find out its present value to the date of, change. Suppose date of change mein aa gaya 8,000. That means provision should increase by 1,000. Are you understanding? I repeat. Year 0, year 10. We estimated that the provision will be 20,000. We have to spend 20,000 for site restoration after 10 years. So we found out its present value. Present value it came 5,000. Then it is unwinding every year because of interest. So year 1, year 2, year 3, after unwinding interest, suppose it comes to 7,000. 3 years ka interest is unwound. Now over year, this is date of change. DOC, date of change. We are seeing that date of change mein now this should be 30,000. So 30,000 ka present value as on the date of change. That means you will present value by discounting for 7 years. You found out that this is 8,000. So you have to increase your provision by 1,000. So to provision for DSR. How much? 1,000. And thereafter you keep on unwinding this 8,000 and it will become 30. When you are crediting provision, what will you debit? If you are following cost model, then you will debit PPE. Because if provision is increasing, your asset cost will also increase. Correct? But if you are following revaluation, then you will debit revaluation reserve. So that means provision is increasing, revaluation is decreasing. Yes. Sir, why like that? Just imagine. Suppose PPE was 100 rupees. Correct? PPE ka cost was 100 and fair value was 400. Correct? So revaluation reserve was how much? 300. Now due to DSR, provision for DSR increased by 20 rupees. If this increased by 20 rupees, cost increased by one, cost increase because we said no. If DSR is a part of cost, so if DSR will increase, cost of PPE will also increase. So chartered cost of PPE from 100, it will become how much? 120. Fair value remaining same, 100 to 120. Then your revaluation reserve will become 280. So if DSR increases, cost of asset increases, cost of asset increasing, fair value remaining same, this difference is your revaluation reserve. So revaluation reserve will become how much? 280. So you need to decrease revaluation reserve by 20. That's why we debit revaluation reserve. Am I clear? So if provision increases, cost increases. Cost increases, fair value remaining same, revaluation reserve will decrease. Because earlier cost 100, fair value 400, revaluation reserve 300. Now because DSR increase, cost increase, fair value remaining same, this will become 280. Correct, chartered? Yes or no? Yes, sir. Step 1, calculate the amount of change in DSR. Calculate present value of revised estimated DSR on the change. How estimate revised DSR at the end of useful life? We estimated 30. Present value it to date of change. That is third year ke end. That is, we'll discount it for 7 years. It came to 8. So this is 8. Old was 1. So increase by 1. Accounting. Increase, decrease. So you will impact PP. But if there is revaluation, then the change will go to revaluation reserve. That same suppose I have given. Correct. Now chartered, suppose PP under revaluation model is this, will help you solve practical questions. Suppose balance sheet में PP is 10 rupees, revaluation model में, so this is fair value and this is provision. So fair value is equal to revalued amount 10 minus provision, or revalued amount is equal to fair value plus DSR. So what is the fair value of the asset? 10 minus 8. 10 minus 2, because the person who will buy for 10 rupees will deduct 2 rupees. Correct? So we say fair value is equal to revalued amount minus DSR, or revalued amount is equal to fair value plus DSR. This will help you solve questions. Am I clear? Then chartered, first time adoption is there. First time adoption. What does Ind AS 110 talk about it? 110 says that all assets and liabilities that qualify as assets and liabilities as per Ind AS should recognize. The first point, you have the old balance sheet. Recognize all assets and liabilities that qualify as assets and liabilities as per Ind AS. Recognize all items as assets and liabilities as per Ind AS. De-recognize all assets and liabilities which do not qualify as assets and liabilities as per Ind AS. So now you have recorded extra asset and liability which qualify as per Ind AS, and you remove those assets and liabilities which do not qualify as assets and liabilities as per Ind AS. So now you have got all the assets and liabilities as per Ind AS. Now reclassify all items as previous GAAP to classify as per Ind AS asset, liability or equity. So after recognition, you will, the old assets you will reclassify as assets, liability, equity comfortably. So recognize all items as assets and liability that qualify as asset and liability. De-recognize all assets and liability that do not qualify. Reclassify all items as previous GAAP to classification as per Ind AS. Previous GAAP it would have been PP. In Ind AS it would become investment property. Previous Ind AS it was some other asset. This Ind AS it is some other asset. Previous Ind AS it was asset. This Ind AS it is a financial asset. Correct. So previous gap mein it was PPE, Ind AS mein it becomes investment property. So reclassify. Previously it was current asset. Now it is a financial current asset. So reclassify. Now we'll have all the balance sheet mein all the items as per classification of Ind AS. So first remove those assets and liabilities which do not qualify as per Ind AS. Recognize assets and liabilities which qualify as per Ind AS. Then reclassify, your balance sheet will come proper as per Ind AS. But the valuation part charted. Measure assets and liabilities as per Ind AS. Now measure all the assets and liabilities after you have done the reclassification as per Ind AS, and the difference in the balance sheet is transferred to retained earnings. Remove, include, reclassify, value as per Ind AS. New balance sheet will not tally because you have changed the valuation. The difference will go to retained earnings. All measurements and classification should be done retrospectively, barring few exceptions which are discussed in respective Ind AS. Some should be done retrospectively, some should be done prospectively. Let's come to this. Retrospective application exemption is also available as optional exemption for PPE, which is known as deemed cost. That means PPE also you are supposed to value as per Ind AS. Like in AS, old AS, DSR was not there. Correct. So when you value as per Ind AS, you have to include DSR. So you have to find out DSR as on day one. Correct. So retrospective application adjustment exemption is also available in this as optional exemption for PP. Like I told, all assets and liabilities should be revalued or should be valued as per Ind AS retrospectively, barring some exception. This exception is applicable to PP, but is an optional exemption, which is known as deemed cost exemption, that you may not follow retrospective, you may follow prospective, and that is known as deemed cost exemption. Entity has opted for deemed cost exemption? No. Then retrospective application is required. Entity has opted for deemed cost exemption? Yes. Then prospective application is required, where deemed cost be considered as cost of PP for Ind AS 16 from Ind AS 16 to transition date. Whatever is the for calculation of deemed cost, two options available. So we are supposed to find out deemed cost as on the transition day. How to find out the deemed cost? Option 1, deemed cost as on transition date is equal to fair value of PP as on the transition date. Whatever is the fair value, that is the deemed cost. Option 2, deemed cost as on transition date is equal to carrying amount as per previous gap plus adjustment of DSR. I told you, no, old AS में provision for DSR was not there. That means carrying amount as per previous gap AS के हिसाब से add adjustment of DSR. Adjustment of DSR, present value of DSR on the acquisition date minus depreciation up to transition date. देखो यहाँ पे लिखा हुआ है acquisition date. We have to estimate life ends पर कितना होगा because there was no DSR earlier. So we assumed X. Present value of X at the rate of whatever percentage for 10 years. Say suppose alpha. Then you go on depreciating it. That is the estimated DSR. Adjustment of DSR is equal to alpha minus depreciation. Am I clear? Yes, no. But charted the rate which you are taking, that you will take as on the transition date. So I assume, I'll tell you. Once again for recapitulation. PPE का adjustment क्या करना है? When we are transitioning from old gap, that is AS to Ind AS. Ind AS says check whether it is as PPE as per Ind AS. Yes. Whichever model you are following, keep following. Now that value should be as per Ind AS. To find out the value as per Ind AS, you are supposed to do retrospective application. That means find out the value as on the acquisition date as per Ind AS, depreciate as per Ind AS, and find out the cost as on transition date. I repeat, find out the cost as per Ind AS as on acquisition date. Then depreciate it as per Ind AS up to transition date. That will become your cost. But charted practically, sometimes it is not possible because you might have purchased the asset 20 years ago. 20 years ago ke pehle to find out the cost, it was not possible. So they have given an exemption that instead of that you can go for deemed cost. Now what is deemed cost? Deemed cost says deemed cost is considered as cost of PP as on date of transition. What is deemed cost? It is considered as cost of PP as on the transition date. How to find that? First option. Whatever is the fair value of PP, whatever is the fair value of PP as on the transition date, that will be treated as deemed cost. Or whatever is the carrying amount of PP as on the transition date, add adjustment to DSR, that would be considered as deemed cost. So deemed cost के लिए दो option. Option 1, whatever is the fair value, that will be considered as deemed cost. Or whatever is the carrying amount, to that carrying amount as per old AS, add adjustment of DSR. How to find out the adjustment of DSR? Calculate whatever you are going to spend. Find out its present value as on the date of acquisition, rate as on the transition date. So charted, this is the useful life ends, this is the acquisition date, and my face is your transition date. From useful life you present value it to acquisition date. Rate, discounting rate as on transition date, because discounting rate as on acquisition date, it is not practically possible to find out. So you will find out DSR which you are going to incur, uska present value as on acquisition date, then depreciation up to transition date. That is adjustment of DSR, you do it. Am I clear? There is one small question which is solved also over here. You will understand it. Am I clear? So chartered, we have discussed entire PPE. First we discussed definition of PPE. Correct? Then we discussed what is not included in PPE. Then initial recognition, 4 types. Subsequent recognition, where we discussed additional expense, component accounting, depreciation and revaluation. Correct? Revaluation also 2 types. Then we discussed chartered derecognition. That is when you sold the asset. Revaluation reserve should be transferred to retained earning. Then we discussed 2 special cases, change in DSR and Ind AS 101. Ind AS 101, if you want, you can discuss it along with 101. But I have a habit of discussing Ind AS 101 in respective standards only. So I discussed it. So that's all for your Ind AS 16 PPE. See you soon with the next standard. Till then, bye-bye, take care.